Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, Scott, welcome back to the Market Minute. It's been a minute.
Yeah, it has. It has. A lot has transpired since we last had this.
Yeah, we took June off so that we could do our annual summer social, and that was a ton of fun for everyone who got a chance to attend. And so the last time we did a Market Minute was in May, and it might as well have been 2023.
Yeah, it's funny. I think there's a saying. It says there's weeks when years happen, and then there's years when weeks happen. And this is something where we've seen a ton of things happen in a pretty short amount of time.
I think we need to add to the saying, and there's days where a year happens. I mean, you can't even get your head around the breaking news now, where it feels like every day breaking news is hitting, and by the end of the day there's a contradiction to whatever breaking news cycle we heard an hour earlier. And in fact, it was kind of funny, Scott. I got yesterday a breaking news article. I'm subscribed to the Wall Street Journal, and I get the breaking news updates. So the one headline came through at 9:43 a.m. Breaking news: Trump indicated he is likely to attempt to fire Jerome Powell as Fed chair soon. Now, I didn't have a chance to read it. I was going to get to it. Thought, I wonder what was said there. By 10:18, not even a half an hour later, breaking news from the Wall Street Journal: Trump denies he's attempting to fire Powell. So, good thing I didn't read the first article.
Right. Yeah. No, and that's been the cadence of the last, 6 months or so, where news comes fast and furious, and there's a lot to, a lot of chaff to kind of sort through to figure out what's truly going on.
Yeah. You were sharing with me an analogy from Extreme Ownership from Jocko about cutting out the noise. What was that?
Yeah. So I was listening to a podcast this morning by a popular military podcaster, and he was talking about military radios and the squelch dial or the squelch button. And what the squelch dial or button does is it reduces the background noise. So if you're on a two-way radio and things are coming through garbled or you can't hear them very well, you use the squelch button and it dials down all of that background noise so you can hear the message you're trying to hear. And I think that's a good, apt analogy, Paul, for what we're looking to do today with some of the economic data we're going to look at, to say, hey, let's use the squelch button and kind of tone down some of the noise and say, hey, what is the actual economic and market data that's relevant and what's actually happening with the real economy.
I love that because, it's we live in a world where everybody's vying for our attention. And the more emotional and agitating the headline, the more people want to click on it. And so everything is sensationalized.
Yeah.
And so, I think it's a great conversation to have as we talk through, what's gone on for the last little bit in the economy and in the markets and how it impacts retirement, pushing that squelch button to say, let's cut through the sensationalized version of this and let's talk about the data.
Yep, absolutely.
So that might be a good segue to dive into today's economic updates. So
yeah, so what I thought we could begin with today is just kind of where we've been with the markets and where markets are at today. And so circa February of this year, markets were on tear. They were doing extremely well, and then some of the tariff and other discussion entered the fray, and markets fell precipitously. There was a steep decline. The S&P fell nearly 20% from its February high to its April lows. It was about an 18% drop. Since then, markets have really found their footing in a big way. And year to date, we're actually up 7%. So that's a pretty remarkable reversal to go from a intra-year low of being down 18% and then back up on the other side where you're actually positive to the tune of 7% for the year. And so what it feels like is markets have shrugged off a fair amount of geopolitical news and a fair amount of economic news without too much pushback. And so that's been interesting to see.
It's comforting on some level anyway. I mean, it's comforting might not be the right word, but I think it is indicative of a resilient economy.
Yep.
In spite of all these breaking news headlines and how fast and furious things are flying, for the market and our economy to continue to slug through it.
Yeah. Yeah. And speaking of the economy, we have kind of our next slide here, and that shows us where GDP is. So GDP is the broadest measure of how the economy is actually doing. And the Atlanta Federal Reserve publishes a really cool statistic, and it's called Fed GDP Now. And it's just a representation of their statistical estimates as to this point in time. Where's the economy actually at? And their last print, which was July 9th, was 2.6%, which is about 3%, which is where, the U.S. economy should be. If we could be in 3 to 4% growth in perpetuity, that's kind of Goldilocks. That's like nirvana as far as where you want to be from that perspective. And that might surprise some people because depending on kind of the press that you're reading, the coverage is all over the place there, but the actual economic output has been fairly resilient. Next slide.
Let me just touch on this real quick, if that's okay. So I just think, we talk about the science and psychology of retirement. I think a lot of times we get clients who hear terms like recession, and I don't know that they fully understand that definition of what a recession is and why this becomes so critical, because so GDP, gross domestic product, so how much stuff as a nation we're able to create and sell, how many widgets we sell and how much stuff we create, and that GDP measures that output. And so recession just means we had 2 quarters of a negative GDP, right? Where we weren't producing as much stuff this quarter as we did last quarter.
Correct.
And so if we get 2 of those back to back, then by definition we call that a recession. And so everybody has been kind of holding their breath for this big recession, right? And I think it's okay to have that awareness and fear that just in case some of this stuff happens because of all these geopolitical concerns that we're up against, but this slide is saying we're actually experiencing some pretty positive GDP right now.
Yep, absolutely. And we've had calls of recession for a longer period of time than I can remember in my investing lifetime, and it just hasn't materialized, which obviously is a good thing. One of the economic metrics, though, that we're watching really closely is inflation. And so inflation has been kind of on the front page over the past few years. And the $100,000 question is, has the inflation genie been put back in the bottle? And how do things like tariffs impact inflation? And so this week we've had some kind of conflicting inflation data. So the consumer inflation data showed an increase, showed it going from 2.4% up to 2.7%. If you look at the chart and kind of that June data, you'll see a little blip upwards, and that's indicative of consumer prices rising. Flip side of that, surprisingly, producer prices were more muted, and those actually came in fairly favorably. So this week we had some mixed inflation data. We have yet to see the full inflation impact of tariffs. Ahead of kind of the tariff announcements, companies really ramped up their inventories. The Targets, the Walmarts, et cetera, of the world really ramped up those inventories. Those inventories get depleted over time, and when they do get renewed, they'll be renewed at theoretically higher prices. President Trump talked about tariffs between 10 to 15% on 150 countries just yesterday, and those tariffs will have some effect on inflation. The question is when and how much. And so over the next few months, inflation data will be very key to keep an eye on.
Scott, this one kind of let me chuckle about how fast news comes, right? We get one day's news inflation's ramping up, and the next day's news inflation isn't. Talk to us about maybe, the consumer price index versus the producer's price index.
Yeah, so the consumer price index is going to be a broad basket of consumer goods that you and I and everyone in the United States actually pays for the things that we use. The producer price index is going to be the price of inputs that people use to produce the goods that we get. And so both of them have, kind of some utility where, consumer price index might be more of a lagging indicator, and producer price indexes might be more of a leading indicator.
Yeah.
But they both have kind of their value.
Yeah. Very good. Thank you.
Yeah. Another metric that we wanted to, kind of share with our audience is how expensive or inexpensive stocks are. And so there's a number of measures of this. I used what's called the Shiller price to earnings ratio, and it's just a measure of how expensive stocks are relative to the earnings that they're generating. And so I would say pay more attention here to the chart than the actual numbers on the chart, because the directional things we're seeing here are important. And so we can see going into 2022, where we had the big market pullback, price to earnings ratios had really gone through the roof. And then we had the huge 2022 pullback, and then you can see kind of going into 2024, 2025, we had PE ratios skyrocket, fell with the decline in prices in April, but we're back up kind of near high water marks. And so stocks aren't cheap right now. This isn't like a blue light special screaming deal time for stocks. That doesn't necessarily mean that a decline in stocks is imminent. Next slide that we have here.
Sorry, I'm just going to break it down again, if that's okay. So just because I know, again, some people hear things like PE ratios, and they're like, I'm not totally sure what that means. So the price of a stock, what you're able to buy the stock for versus the earnings that stock is creating. And so in theory, there should be like a correlation that says a stock is worth X because it's able to generate Y in earnings. But sometimes we'll pay a lot more for a stock than it's been generating in earnings.
Yep.
And we do that for any number of reasons, right? Maybe we have, strong conviction that stock is still heavily growing and it'll be worth more down the road. Maybe it's just the general market sentiment where we've pushed the pricing up because everybody's kind of crowding into a space. But when we take that ratio of price to earnings and we watch it go up, 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 in theory, that's indicative of something being overpriced. It's expensive.
Yeah, no, that's spot on. And P's are interesting because it can be things like the quality of the earnings can be a determinant there.
Yes.
So it might be, hey, we think you were a one-hit wonder with this particular set of earnings. So even though your actual PA ratio is high, we don't think it's sustainable. Other companies like Tesla and NVIDIA and others, even though their current level of activity doesn't warrant it, the expectation for future growth, makes people a little bit more optimistic and willing to tolerate much higher PE ratios.
Right. So that's an important metric for us to observe, but it doesn't necessarily mean just because something looks expensive, it doesn't necessarily mean that we're poised for some kind of major problem. I mean, I hear people all the time, and this is human nature, will anchor to things like 2008 real estate prices. And for a lot of years, people would anchor to 2008 real estate prices, and they'd look at a house that was worth $500,000 and they'd say, don't buy it because I remember back in 2008, that house was worth $250,000. So they would anchor to that number. But as we've watched over the last, 17 years, that $500,000 house now is $1 million. And so it doesn't necessarily mean just because something looks expensive that it is in fact a bad time to buy that thing. Is that fair?
Absolutely.
Yeah. I think you've got a slide here that might even further that point.
Yeah, because markets and economics is such a nuanced area. Economics is like sometimes disparagingly referred to as the dismal science
Yeah.
because it isn't like a cut and dry black and white thing. It's not like physics or chemistry where it's super formulaic. And markets can remain at high levels for an extremely long period of time. So just because markets are high, just because PE ratios are high, doesn't necessarily mean a decline is imminent.
Yeah.
And this slide, I think, is particularly interesting. There was a study that was done back in 2017, and what the slide illustrates is the S&P has spent since 1950 about a third of its time within 5% of its all-time high. So what that means is when we see markets hitting all-time highs on a regular basis, when we see that all-time high being hit, it doesn't mean a decline is imminent. In fact, it might mean that it will persist at all-time highs for an extended period of time.
A third of the time.
Yeah.
Just because you reach that high doesn't mean you're gonna say, oh, I better call my shot and get out now. A third of the time, you're hanging out right there.
Yep. And that's why we all invest. Markets are up far more than they're down.
Yeah.
3 out of every 4 years on average, markets are up. And
Yeah.
that's why investing is such a awesome long-term endeavor.
Yeah. I mean, especially when we talk about earnings and we have a clear understanding of we own quality assets that produce these earnings. I had a good conversation literally just yesterday with an individual who loves real estate, and as I tried to understand where they were coming from, the way they described it was, I know the real estate, I know that there's an asset there, there's bricks, there's dirt, it's always going to have value, and it doesn't move around in value like stocks do. And without attempting to challenge him, my goal was more like, let's step back and just talk about the principles of investing as a whole, because real estate is a great investment. We both own real estate. It's a good investment. But I said, I bet if we took a digital sign and hung it over top of your real estate holdings and were able to plug it in to some kind of supercomputer that showed sale prices of similar homes, in real time, and hung that over your house so you could see that change in real time, because you're probably checking on the house value once every year, maybe once every other year even. Said, I bet if you saw that changing in real time, you might think differently about that, because the price of your real estate does in fact change minute by minute, day by day, hour by hour. It just changes based on buyers and sellers. You just don't know that.
Right.
We don't have access to how quickly that number would change, because those transactions are far, far, far less frequent than the transactions that would take place in the market. But if I own a share of McDonald's, I can go to that store and I can say, I know this is one of tens of thousands of similar stores that I have a piece of ownership to. And I can look at the earnings that these stores are able to generate. And I can say, I've got a share of the value of this business, the asset value of the brick and the mortar and the dirt. And I also have a share of how much money it's generating in earnings. The difference is I get real-time updates on what that's worth minute by minute, and that can feel scarier.
Yeah, I love how you've articulated that, because the efficiency of markets and the price discovery real time that we have, where we know exactly what something's worth, on the market at a given point in time, is kind of a two-edged sword, right? That price transparency is super helpful for acquiring assets at appropriate levels and really beneficial that way. But the flip side is, psychologically, it can drive us crazy, right? If we fixate on that and look at that movement with too much frequency, or get too fixated on it, that can be a maddening exercise.
Well, I think this next slide, helps illustrate that point, where, we can look at, for the last century, all of the significant crises that we've endured, and these are real issues that have persisted throughout our nation's history. You and I, Scott, aren't old enough to remember a lot of these young ones, a lot of these old ones here, but we lived through a number of these problems, and many of our clients have lived through most of these problems. And if every single time a crisis like this showed up, our response to that crisis was, I have to get out of my shares of McDonald's. I've got to get out of my shares of Home Depot and Microsoft and all the other investments that are out there. I've got to sell all those. We probably would never, ever be invested because these have persisted for a century now. And yet, in spite of this reality, the stock market's averaged 10.5% per year.
Yeah. Yeah. It's interesting. So I just anecdotally, one of my kids, he's about 10 years old, and we've started to watch the Marvel movies together.
Yeah.
And we've had fun doing that. And in one of the Marvel movies, at the end of the movie, there's a comment about, hey, the one constant out there in the world is trouble. There's always trouble.
Yeah.
That's always present. And that's been the case for investors, as old as time. I've gone back and read economic history about the Rothschilds and, early merchant bankers and things along those lines. And there's always been conflict and trouble and unrest and economic issues. And that's not unique to the time that we live in, but those who kind of stick to the investment fundamentals, that's the best long-term accumulator of wealth that the world's ever devised.
And I think the theme that we hear all the time is, but this time it's different, right? And I don't want to be tone deaf to the realities of the fears that we face, or to the potential threat and exposure that does in fact loom. I really don't want to come across tone deaf there, because I think that people justifiably should be anxious about some of the things that we are up against today. The last thing we want to do is just be like, bury our head in the sand and everything's going to be just fine, because that's not a fair approach either. We do have to be mindful and intentional about how we invest our money.
Yeah, and just real quick on that point, Paul, because I think this is super important. Market fundamentals and human nature and those types of things don't fundamentally change, and so those kind of are some core principles that we think about when allocating clients and creating investments. But the application of those principles can evolve, and so in the spirit of hey, we don't want to be tone deaf to what's going on. We recognize that there's things in the world today that didn't exist even 20 years ago.
Yep.
We have AI, we have cryptocurrency, we have things that are very consequential, and we need to make sure that we take those into account. But the fundamentals of markets track earnings, human nature has been unchanged for thousands of years. Those are the types of principles that you can kind of build your investments upon.
I love that. And so just, studying what the evolution of the market looks like, and the evolution of our, integrated global economy and currency and currency exchanging and values there, that's all looks very different today than it did 20 and 30 years ago. And so we obviously need to be mindful of those things and plan accordingly. But to your point, if we go back 100 years, markets track earnings. 98% correlation.
Yeah. Markets
track earnings. So that's what we need to fundamentally base our thinking around. No different than real estate. If given enough time and purchased, a good quality asset, if we own something in a good community, it's going to generate a good income for us, and it will appreciate in value.
Yeah.
They don't make more land. They don't make more land. So there's another great slide, Scott. Talk to us about what you see here.
Yeah, and this just kind of builds upon the discussion we've been having, Paul, where we know that markets are volatile, and we know that volatility is the price of admission to invest. But I think this one's interesting. On average, markets drop by 14% at some point every year.
Yeah.
So it's very seldom to have a year where every month things go up and we have these nice linear growth trends over time. We will have drawdowns on a regular basis in markets, and they can be significant. You look at, some of the different years out there where, having 20+% intra-year drops, if people panicked and kind of headed for the hills at those period of market declines, they would have missed out on the subsequent rebounds.
Yeah, I think one of my favorite ones here, they're all over the place, right? But like you get years where the intra-year drop here in 2012 was a 10% drop. The year ended at 13% positive. So just to further explain this, the red dots down here all represent how low the market fell sometime that given calendar year. So the low point during that calendar year, right? So go to 2008, the market dropped 49%, was the lowest it ever got, but it ended the year at a 38% actual drop. Okay.
Yeah.
So the gray lines are the actual return of the year. The red dots are the intra-year drop. But it's so fascinating because 14% is the average intra-year drop, but 34 of 45 years, the markets actually ended in positive territory. So we can't allow our emotions to dictate our game plan.
Yeah.
We've got to stay a little more convicted there. So Scott, we just got a couple minutes left. I wanted to share one idea with the signing of the new tax bill. There was a significant adjustment that took place that's going to be very relevant to our clients. And I thought I'd share that in the last couple minutes we've got left. So I'm sorry, if we take a scenario here of this might be a typical client scenario, age 70 and 68, we'll say there's a $50,000 combined Social Security income between both spouses and another $50,000 IRA withdrawal, allowing this households to spend about $100,000 a year to buy their bread, milk, and eggs and some travel. So the first thing we do in order to figure out what their tax liability is going to be is we calculate what we call their provisional income. And this is how we get to a Social Security tax, because as we know, not all Social Security dollars are subject to tax. And so to get the provisional income, you take all the IRA money, that's all taxable, and then you take half of the Social Security number, which is $25,000. So $75,000 is tax, what we call provisional income. And then we figure out how much of that is subject to tax. So based on the provisional income calculus, because they exceed those thresholds, 85% of their Social Security is subject to be taxed. So that's $42,500. Then we take the $50,000 IRA, the taxable portion of their Social Security, which is $42,500, and that gives us a $92,500 adjusted gross income. And I apologize, I'm going through this quickly. The principle will hold up here at the end. You don't need to memorize the detail. But prior to the One Big Beautiful Bill, which is such an interesting name, our standard deduction for married filing jointly was $30,000. But they had what they gave was called an extra deduction if you were over the age of 65. And if you were married filing jointly, it was $3,200 was kind of an extra deduction they were offering. Now, since this bill has been passed, we now have taken our standard deduction and increased it to $31,500. So an extra $1,500 applies to the standard deduction. Now, this extra deduction is significantly increased. It's a big number. It's $6,000 per spouse if you're married filing jointly, if you're over the age of 65. So it's going all the way to $15,200. So from $3,200 to $15,200 plus an extra $1,500 in a standard deduction. So in this scenario, we take the standard deduction off the adjusted gross income, we take the senior bonus deduction of $12,000 and the extra deduction of $3,200. So we get $46,000 of total deductions, which, we take that off of our adjusted gross income. We only have a taxable income now of $45,800. So that puts us somewhere around $5,000 of total tax. The math before the July bill was passed would have been about $1,600 higher. So that's $1,600 of real dollars back in our clients' pockets, to understand how this applies. And to just take this even one step further, many of our clients can forecast their charitable contributions. And let's say this particular client was giving $10,000 away to charity every year. They could take that distribution from the IRA withdrawal. Instead of writing a check out of the bank account, they could do what's called a qualified charitable distribution and donate $10,000 of the IRA withdrawal to the charity that they'd like to donate that to. And it would take a $5,000 tax bill all the way down to just over $3,000. So that's a very significant opportunity that we want to make sure everyone is aware of, because, between understanding how that works and this new tax bill, we're talking about a potential savings of something like $3,600. And that's not just deductions, that's actual cash.
That's real money. Yeah.
Real money back in their pockets.
Yep.
So super important. Go ahead, Scott.
Yeah, and I was just going to add to that, Paul. The interesting thing about that additional kind of age 65, or at least a portion of that, it is set to sunset in 2028.
Yeah.
Which is interesting. And so you'd want to kind of walk through this with your financial advisor, but if you are on the margins with taking the standard deduction versus itemizing, and knowing that this larger standard deduction is going to sunset absent any additional action from Congress, you might, if some of your gifting, if you're gifting appreciated stock, for example, or not gifting out of your IRA, you might defer that a couple years, right?
Yeah.
And take the larger standard deduction for till 2028, and then post 2028, you could really load up on your itemized deductions and do some catching up there if you desire to do so. So I think there's some planning opportunities there to take advantage of. And
emotionally, sometimes people don't like the idea of delaying it. So sometimes what we'll do is we'll say, fine, then let's just front load it.
Yeah.
We'll front load your charitable contributions, and then we'll take some standard deductions on the back end, or we'll use things like donor advised funds, DAFs.
Yeah.
So there's a lot of, like you said, good planning opportunities here. And I think the takeaway is, we're not CPAs, and we don't, provide like tax planning services. We don't, or preparation services, I should say, and we don't give tax advice, but these are concepts that we understand and we want to make sure our clients understand. And so the takeaway is, come and talk to us, have our clients, meet with us so we can walk through how this applies, and ensure that everyone is getting the most out of the opportunities that are in front of them.
Yep.
So Scott, I think with that, it's probably a good place to wrap up. It's been fun.
Yeah. Yeah. Always good to catch up on these topics. And yeah, we look forward to next month.
Look forward to next month. And just always make sure when we're talking, to our clients, if you want to go far, you want to work with the team, and have a good game plan and know where you're headed. And we appreciate our clients and the opportunity to be a part of that team with them. So
for sure.
Thanks everybody. Until next time.